Hi, and welcome back to CPE's Investment Matters. I'm Paul Rosta. If you ever find yourself in Washington, D.C. some Saturday night, you might have a chance to catch a band called 16th and T. They specialize in the classics, Tom Petty, Peter Gabriel, Aretha, to name a few, and they've got a pretty slick keyboard player named Alex. Now, he's going to get mad at me for saying this, but the fact of the matter is that Alex is the model of an overachiever. And it's not just because he plays guitar and bass as well as keyboards. He's got two graduate degrees from Harvard. He served as an advisor to the World Bank and the Inter-American Development Bank. And when he's not playing tunes on the bandstand, Alex Nyhan is the CEO of First Washington Realty, an owner-operator of grocery-anchored neighborhood retail centers with a 20 million square foot national portfolio. In this episode of Investment Matters, Alex tells us why he thinks this is a fun time to be a private owner of neighborhood retail real estate, how First Washington is investing in its centers to keep them fresh and competitive. He'll give us his take on how the capital markets are looking at neighborhood retail. He also shares how his unusually diverse experiences in the public and private sectors have influenced his approach to business. And if you stick around to the end, Alex and I will even talk music for a minute or two. Take a listen. Alex Nyhan, welcome to Investment Matters. Really nice to be with you today.
Thank you, Paul.
Well, let's jump right in and start with a look at the big picture for retail real estate. One of First Washington's main sweet spots, of course, is necessity retail, and that's been a consistent performer through widely varying economic conditions. How would you assess the sector's performance as far as tenant demand, occupancy, rents, and other key indicators? And how do you expect things to stack up this year compared to the past couple of years?
Well, I'm always careful with predictions. But why don't I start by telling you a little bit about why we invest in the centers we invest in, because we're investors first.
Sure.
And then why don't I try to hit your question about assessing the sector's performance. So we've been in business since 1983. Important year, the greatest music year in history. Also, good year for the Boston Celtics. And we've been doing the same thing for 42 years, which is we own grocery anchored neighborhood and community shopping centers. And the reason that we own the same thing is we're not smart enough to own anything else. And what I mean by that, with all due modesty, is we feel as investors that we can understand the likely performance of grocery anchored shopping centers no matter what the economy is doing. And since we're investing our own cash in these centers, we need to have that level of comfort to feel that we can make the investment. So other property types, and I used to be a mixed use developer before I came here, so a lot of experience in multi-family, hotel, etc. Those are great asset classes, but when we're investing our own money, we feel that we can understand the role of a neighborhood shopping center in an excellent neighborhood where it's around the corner, close to home, does well in good times and in bad times, and where it's almost impossible to build any competitive supply. So if we feel that if we can own those types of centers, that we'll be able to grow rents over time, and we won't have to spend an excessive amount of capex on the real estate. So that's why we're invested in the sector. As to your question about how are things going overall in the sector, things are going really well. It wasn't that long ago that retail was unfashionable and people were worried the internet was going to eat, retail real estate in the United States. What's happened is it's really been a tale of two cities, unfortunately, for the mall sector, where, while there will always be probably 10% of the malls that were in this country up until a few years ago that are just the absolute creme de la creme malls, the fate of malls has diverged very significantly from the fate of neighborhood shopping centers. So that 7 years ago, malls and neighborhood shopping centers had about the same level of occupancy. And now the neighborhood shopping centers have the same level of occupancy, and the malls have dropped probably 700 basis points. So one of the reasons for that is, yes, the internet, because the internet has been tougher on the quote unremarkable middle retailers that can be found sometimes in malls. But the other thing is the internet and the rise of e-commerce has taught the retailers, including the so-called digitally native retailers, why owning real stores is so important. So now in the open air space or the neighborhood shopping center space, you got a couple things driving the really successful recent occupancy. One is in the most basic sense, retailers' sales have been booming. They've been booming over the last few years, and the sales growth of retail in the United States has massively outperformed inflation, which is kind of hard to do because there's been a lot of inflation over the last couple of years. But it's not just the sales, it's that there's effectively no new supply because it's expensive to build new shopping centers. But if you go a little bit deeper than those pretty well documented attributes, the other thing that's happening right now is you've got these three other demand drivers that are really elevating occupancy in our type of product. One of which I already mentioned, which is the so-called digitally native retailers like Warby Parker wanting to have bricks and mortar stores because they know they do more business if they can have a physical store. Um, and secondly, those types of retailers that want to be omni-channel or be able to sell to you on your iPhone or through a store, they have a choice. Hey, as a retailer, do I want one or two landlords? Do I want to have a retail landlord and an industrial landlord, or do I just want to have a retail landlord? And so a lot of those tenants are making the decision, hey, I just want to have one retail landlord. So for that reason, they're fulfilling orders out of their space, not just selling stuff out of their spaces. And the last piece that's really helping demand for the neighborhood shopping center sector is that there are a lot of retailers that want to be able to meet the customer closer to where they live in their neighborhoods, especially given the rise of hybrid work. And so you have a lot of mall tenants like Foot Locker and Bath and Body Works who are now trying to get space in neighborhood shopping centers. So all in all, whether you're us or one of our competitors, it's a pretty fun time to be an owner of neighborhood shopping centers.
Well, to follow up on a point that you were making a moment ago, what innovations are you seeing in the tenant mix? For example, there's a venue called Level 99 that is, I understand, is going to be joining the Corbin Collection. And
Yes.
for the benefit of our audience, the Corbin Collection is an upscale open air center in West Hartford, Connecticut. Would you mind telling us about Level 99 and what that kind of attraction might tell us about the evolving expectations of today's retail customer?
Sure. Well, I'm really excited about Level 99. It's a roughly 40,000 square foot use on the second floor of our center that you mentioned is called the Corbin Collection. And what this use is basically a series of high-end games and high quality food and drink for grown-ups. So the very innovative concept backed by really smart equity in the business. We also happen to own the shopping center next door with our partner Regency Centers, which is called Corbin's Corner. So in this one great node where you're coming right off the highway, you see both centers. If you sort of go to the right where Corbin's Corner is, you have a Trader Joe's anchored monster neighborhood shopping center in really the part of Hartford that you want to own in, which is West Hartford. And then right next door to it, you have the Corbin Collection, where you'll have this more experiential set of uses with Shake Shack and other tenants. What I love about Level 99 though is it's not just the innovation, and it's not just the fact that they're paying us some good rent on the second floor. It's a deeper issue, which is that it will create an emotional connection for our customers. As I'm sure you know, Americans are lonely these days. There's tons of data that shows that the more time that people spend at home, shopping at home, being entertained at home, even worshiping at home, the lower their self-reported happiness is. So while it may be more efficient to do these things at home, people are less happy doing them at home. So I think for us as a landlord, we need to not just be a place that can be an efficient area to do errands. It also has to be a place of a little bit of more emotional resonance where humans can come together and hang out. So Level 99 is hitting that note, while right next door we can have Trader Joe's hitting the convenience note.
Let's talk a little bit more about investment. Over the last few years, I understand that you've averaged about 900 million annually in investment volume. And what would you say are some of the upsides of being a private investor in this environment? Are there any advantages when it comes to the capital markets, or is it really still challenging at times, whether you be public or private?
Well, I love being private. Earlier in my career, I worked in a publicly traded company, and that was an awesome experience. But as an investor, I find it simpler to be private. It definitely clears the mind. We write checks, as I mentioned, for every center we own. We write checks for every dollar of tenant improvements we offer to a tenant. And so we think carefully about the capital that we inject. Um, what I like about being private is when we're doing a buyer interview with someone who's trying to sell their center, we can say to that seller, "Hey, you've got the decision makers on the line." I'll give you an example. We did a deal a few years ago where we bought a company called Donahue Schreiber, $3 billion deal on the West Coast. And I remember in the buyer interview, they were like, "Okay, well, can you explain to me how the approval process works? Like, what are the next four steps?" And I was like, "I don't know what you mean. We're good. Like, we've got the cash. We're ready to go." And I think the fact that we can make that type of a commitment to a would-be seller on a phone call makes all the difference. I'll give you one other example. We just bought a property called The Station in suburban Maryland here in our backyard in DC. Awesome Whole Foods anchored center. And when we did the buyer interview, we were able to tell that seller, and that seller owns other land around the center. So it was very important to them to know that we would execute. And they believed that if we said we would do the deal, we'd do the deal. We did the deal. So I think it is a little bit simpler to execute and uphold commitments when you're private.
Regarding the capital markets, are you seeing any categories of lenders becoming more active in retail real estate finance today, whether it be banks, life companies, private funds, any other potential capital sources?
So the banks are back for sure. CMBS is up this year. But we don't really work too much with the CMBS lenders. We're more of a life co-borrower because we tend to use a small amount of leverage and we have very safe properties, and the life cos therefore can be very competitive for us in terms of their our total cost of borrowing. We are seeing some really attractive spreads. We just closed a couple loans at spreads of less than 130 basis points.
Oh, that tells us something right there, doesn't it? Um, what are you looking for primarily in an investment today? I mean, what makes a property attractive for First Washington as far as demographics, location, property size, other factors? What do you like in a property?
Let me give you the two basics, which are going to sound obvious, and then I'll give you some more specifics. The basic things that we look for are quality and the ability for us to make a difference. And what I mean by that is, as it relates to quality, these are some crazy times out there. If you look at what's happening with the stock market, with the treasury markets, the US dollar, there's really a high level of volatility, obviously. And so in that type of environment, uh, I have an even greater sense of conviction that owning, the best neighborhood retail shopping center on the corner is the place we have to be. Some people might say, well, actually, if it's a higher return environment, you should go down the quality spectrum and get a, sort of a higher risk on, higher return type of investment. And that's awesome. I know there are people that are really successful doing that. We don't think we're smart enough to predict the future, and therefore we like owning the highest quality stuff. What I mean by ability to make a difference is, in this environment, if you are going to buy quality and therefore you're not going to be able to steal an asset at a crazy high cap rate if you buy it, you are going to need to be able to have some real income growth that you think you can generate over time, right? And so that's where, because we are vertically integrated and we have an awesome leasing team, we can really lean in and grow rents through leasing, but we do need to see that type of opportunity if we're going to be able to buy quality and have it be a responsible investment. Because the other thing we always talk to our team about is, there may be a great property, but it doesn't necessarily mean it's a great investment, right? Depending on the price you pay. More specifically to your question, we always look for high quality demographics, so income, education attainment, population density. The two things that I think we're most focused on are education and retail supply. So we look very carefully at retail per capita as an indicator because because we don't think we can predict the future, we think it's very important to buy real estate where it's hard to build new real estate. And that's one reason, for example, some of our competitors and our peers have really gone long the Sun Belt. And while we do have Sun Belt exposure because we love owning and we have some great properties in Scottsdale, Arizona, for example, Dallas, et cetera. Um, there are fewer barriers to entry in the Sun Belt, and we're big believers in having barriers to entry so we can grow rents. The last thing I'll say on education is our portfolio has the highest level. If you look at the education attainment of customers that live within 3 miles of our centers, with all due modesty, our portfolio has the highest education attainment by a long shot of any other national portfolio in the United States. And the reason that's so important to us goes back to the inability to predict things. We know that since about a third of Americans have a college degree, we know those incomes, the incomes of those folks historically do outpace inflation, and the incomes of folks who don't have college degrees don't outpace inflation. And because we want to be an inflation hedge, we want to make sure that the spending power of the people that live around us grows faster than inflation. And the only way to ensure that is to buy in neighborhoods where a lot of people have college degrees.
So to your previous point a few moments ago about the Sun Belt, a lot of times these days the focus does seem to be on the Sun Belt, like it's all about those states. But you're clearly seeing opportunity that is not necessarily in that swath of the country. And is there an example or two of a market that is not in the Sun Belt and but you still think is really attractive?
So first of all, I want to be clear. I love the Sun Belt. I just think it tends to get oversupplied, and people tend to pay too much money for assets there sometimes. Um, just to be clear about that, we love our exposure in Houston, Dallas, Austin, Phoenix, Raleigh, South Carolina, et cetera. Specifically, though, to your question, we don't really like circle markets on the map and then go try to hit those
Mhm.
markets. We're a neighborhood level buyer, and the reason for that is you can buy in the wrong neighborhood in the right market, and you can buy in a great neighborhood in a market that may be slightly overlooked. I'll give you an example. 11 years ago, we bought basically on a sole source off market basis, arguably the highest quality retail in suburban Kansas City. Okay, from a great family called the Cosentinos. And as we studied this retail and met with the community and the city council, week after week, we learned a lot. We're like, this feels like great retail, but why does it feel so special? And what we learned was this famous developer called J.C. Nichols, about 100 years prior, had come up with this whole master plan for the area. And in that master plan, Mr. Nichols circled a few holes, and only in those holes could you build retail. And so there are some problems with other restrictions in that master plan, but one of the positives of the master plan was there was such restricted retail supply and very high end housing. Okay, so where we own Prairie Village, literally across the street from us, Mission Hills, at the time was the number three most affluent municipality in the United States. Nobody would have ever said that the number three most affluent town in the U.S. was in Kansas City. Okay, so as we developed greater knowledge of the market, we realized that these shopping centers basically trade as if they're a coastal market, but we were able to buy them at a non-coastal price. And in the ensuing 11 years, they've just been awesome in terms of local tenants, national tenants, remerchandising, NOI growth. And those are the kind of diamonds in the rough that we are especially excited about. Not really in the rough, but they're diamonds in places maybe somebody else wouldn't have remembered to look.
Could you tell us a little bit more about the shops at I'm sorry, the shops of Prairie Village,
Sure,
and also since I think I heard that you recently started a new phase of your project there, and
we did.
I'd be really interested to know your thoughts about the strategy for keeping a legacy historical property like that. as competitive and attractive as possible.
Yeah, so super awesome property. Before we bought that property, I had never been to Kansas City, and I've probably been to Kansas City 35 times now. Um, what's so special about this particular property is, first of all, it has been in the community for a long time. The community feels like it's their property. And when we came to Prairie Village, the city in which the property is located, and basically asked for everyone's blessing to own this asset, we did make a commitment that would be a good steward and we wouldn't kick out all the local tenants. And that's what we've done. Over time, however, we have also upgraded with some excellent new local tenants and, yes, even a few nationals. I'll give you an example. When we bought the property, Macy's, there was a three-level Macy's, 120,000 square feet, the only Macy's department store in our entire portfolio because we don't own malls, right? So this Macy's was paying a very, very small rent, and I negotiated for about 6 years to get that Macy's back. And then, literally in the depths of COVID, they gave us the keys back to the Macy's. Um, and what we've been able to do is take an excellent regional grocer called Hen House, expand them into a state of the art new grocery store, which is under construction right now. The base building portion is under construction. So they'll be the anchor tenant for what used to be this Macy's that, candidly didn't get a whole lot of foot traffic. And we're also in talks with various food and beverage users, fitness. And so it'll be a very lively part of the center. But I'll tell you what's interesting about it is we also carefully studied, hey, should we put housing here? Should we put office here? And we are, if it had made more financial sense to put housing and add it to the center, we would have done that. But the fact of the matter is, it made more financial sense just to lean in on the retail because it's such a special place. So that project's underway, and I think it really shows the power of discipline in not overpaying to sort of recapture a Macy's, and also the tenacity to stick with something for so long. But when it opens, it'll be awesome.
Alex, I'd like to hear more about your own professional journey in the business. At what point did you start to focus on commercial real estate? Was it while you were getting your MBA at Harvard when you were an undergraduate, or did it evolve over time?
No, definitely not either of those. So when I was in grad school, um, I saw a very inspiring presentation by the then mayor of Washington D.C., Tony Williams. Um, I had lived in D.C. for 5 years between college and grad school, and coming out of grad school. I didn't know what I wanted to do. I always had, I went to business school and also public policy. I was kind of, one foot in each world, and I knew though that there was an urban renaissance happening in Washington D.C. And so I figured that if I could go work and be part of that, I could probably learn a lot. And I wasn't sure if I wanted to go more in a finance direction or a real estate development direction, but I figured if I could go cut my teeth and get some deals done, that's probably the best approach. That's what I did. I was very lucky to work for the deputy mayor for economic development and structure a bunch of very, very complicated real estate deals. Uh, and that then launched me into realizing I was really interested in real estate and going to the private sector side, where I worked for a company called Forest City Enterprises, doing mixed use development.
You've touched on one of the things that I find really intriguing about your career is that you have such diversified experience. You were, as you mentioned, worked at Forest City, a
Yes,
prominent developer and owner. But as I understand it, you've also worked abroad as well as in the U.S. You have a Master of Public Administration degree from Harvard as well as an MBA, and you've even served as an advisor to the World Bank and
that's too
Inter-American Development
embarrassing.
Bank.
That's too embarrassing. But yes, it is true.
So, are there a few takeaways from those experiences that um, actually, let me rephrase that. So here's my question. Are there a few takeaways from those varied experiences that you realize now inform your perspective as an executive in this business?
For sure. I think when I worked abroad, I was spending a lot of time working in Latin America between college and grad school. And there's something really humbling about finding yourself in a different environment. And I was lucky enough to manage people who were different from me and older than me. All types of backgrounds, and I think just exposing yourself to different things, different people, different ideas, and putting yourself in uncomfortable situations. For me, I loved it, and I think it really helped me learn. I'll tell you one really sort of strange, counterintuitive piece from Latin America work. I did a lot of work down there in like business problem solving and organizational learning and that kind of stuff. And I thought it was completely unrelated to my real estate career. And it had been completely unrelated until about maybe 3, 4 years ago, probably about 3 years ago, when we bought this other company and we needed to integrate two cultures. In some ways, that's a once you buy the company, it's less of a real estate job and it's more of a leadership and organizational learning type job. And so, strangely, that experience from when I was in Latin America was just amazingly helpful to help manage the integration of two companies. So I'm one of those people. I think you never know. You never know what twists and turns are going to be available to you in your career. Um, but I've always tried to focus on learning and being curious and upholding commitments. And I think I'm really grateful for how it's turned out so far.
Well, now we come to one of my favorite segments of Investment Matters, which we like to call Executives Off the Clock. We can't work 24/7, although it sure seems like we try sometimes. So when it's time for a change of pace, do you have any favorite pastimes or just ways that you take a break from the daily grind?
So I love playing music. When I was a kid until age 22, I thought I'd be a full-time professional musician. And now I do. I play with an awesome band that's I'm lucky that they'll take me, called 16th and T, and we'll play gigs at various nightclubs here in Washington D.C. I don't know, probably every 8 weeks or so, and it's just awesome. There's nothing like playing music. I love to also play with my kids, and one of the things I love about music is when you're in that flow with other people, you can listen, you can improvise, and no one cares what you do for a living.
If I might ask, what instruments do you play, and what kind of tunes does your band play?
So I play piano, guitar, and bass. I play keys in this particular band, and we just play covers. We play like some Aretha stuff, rock covers, Tom Petty, Peter Gabriel, stuff like that.
Excellent selections, if I might say so myself, and I do say so myself.
We don't play any Jay Giles. We got to fix that.
Oh well, got to get some Giles in there.
Absolutely.
Good old Peter Wolf.
Hey, Peter Wolf has a new book out, by the way.
Oh, no fooling. Okay.
Yeah, I read a review of it. It sounds really it sounds worth checking out.
Yeah, for sure. So, well, that's great. Well, Alex, I really appreciate your taking the time to give us your views on everything from real estate to music, and it's good of you to share your views, and I'm sure our audience will really find them very interesting. So, thanks much for the time.
All right, Paul. Thanks for your time, man. Appreciate it. Have a great weekend.
That was my conversation with Alex Nyhan of First Washington Realty. Be sure to follow us on Spotify, Apple Podcasts, and YouTube. You can find archived episodes of Investment Matters and more CPE podcasts on our website, commercialsearch.com. Until next time, thanks for listening and be well.